Welcome to the Daily Update, where I'll go over the action in the market for Thursday, July 6th, and then we'll see how things look for Friday, July 7th. I probably sound a little bit different. I have to record this a little bit different for this video. I have a pretty busy schedule, and I'm not going to be able to record it the other way and do some editing, so you're going to hear me flub my words and mess up and have to start over and things like that, but I just need to get this video posted as soon as possible, and this was the best way that I knew how. We had a pretty significant down day. It looks a little more scary than it really is. We're still positive, believe it or not, but if we see any more follow-through weakness, we're going to start turning more negative. So far, support has been holding, but at the same time, resistance has also been holding us back at the same time. Okay, so let's go back and talk about what happened. Right at the open, we did have a gap lower open, and when you get to the chart, like I said, it'll look scarier because the last few days our range was pretty thin, so it made Thursday's session look really wide. And we dropped down below S1 at 44.38, S2 at 44.28, S3, which we rarely get to, at 44.11, and we even hit S4 at 43.93. We finally found a bottom at 43.85. One of the positive things is a lot of the selling took place right after the open, and that gave a lot of bargain hunters and a lot of the smart money a chance to say, hey, okay, it looks like we're finished going down. Let's go in and start to do some buying, and that really helped things improve. As the day went on, pretty much the rest of the session was spent climbing back above S4, and we closed at about S3. We were down 0.79%, where we had been down a lot more than that, but volume is still below average, and the technicals are positive, but if we see more follow-through, it's going to switch things more negative. A lot of the problem that came out on Thursday was that interest rates were really going up. They were going up pretty far, pretty fast. That started to spook the futures market, and then that bled over into the cash market. And we're still in this in-between land where maybe good news is good news and bad news is bad news. Well, things were coming out a little bit weaker than expected, and so the market just took that as a bit of a concern. We're also keeping an eye on Russia and what's happening there, but my understanding is that the coup person, I forget his name right now, is actually out of Belarus, so maybe that'll help calm things down a little bit, or it could escalate things even a little bit more. What are some comments that we can make? Rising interest rates really pressured stocks even before the open. And then I have a blank point here. On a short-term basis, we still just have our stochastics that are overbought. If you've been watching the videos, we had a pretty long list. Most of that list has been taken off right now. Intermediate term, we're still keeping an eye on our oscillators. They're looking a little bit toppy. They're kind of jumping back and forth. They're not quite sure what to do right now. And then the rate of change going back 200 periods, since that's a longer-term chart, it takes longer for that to update. The dollar was down and interest rates were up, and interest rates being up was the real catalyst for things going lower. We still have all of our yield curves that remain inverted. Sentiment is still extreme positive. It's dropping. It had been at 79 and it closed at 79. Our trend is positive, but now it's declining. We've dropped below the moving average. The ADX is still above 20, but since it's dropping below its moving average, that shows a weakening trend, and the green line continues to come down even though it's still on top. With the down day, our bias is negative, and I've changed our momentum to mixed to negative. A lot's going to really be determined by what comes out with the employment situation report. The economic reports that came out on Thursday, we had a whole slew because some were postponed from Wednesday to coming out on Thursday. The weekly mortgage MBA applications index, it came down minus 4.4. Purchase applications were down 5%. Refinance applications were down 4%. The AD employment change, this is private sector hiring, it was up way more than expected, which also spooked the markets at 497,000. They had expected 245,000. Last time it was at 267,000. Weekly jobless claims also are continuing to fall. They're at 248,000. They had expected 245,000. So it was more than expected, but it's still seeing a downtrend, and I'll show you that chart. Continuing jobless claims came in at 1.72 million. The trade balance was at minus 69 billion, just what they had expected, a little bit better than the minus 74.4 billion that we saw last time. The final IHS Market Services PMI, it's above 50, so that's somewhat positive. It came in at 54.4, down from the 54.9 that we saw last time. The JOLTS job openings were at 9.824 million. That's down from the 10.32 million that we saw last time. And the big one was the ISM non-manufacturing at 53.9. This was greater than the 51.1% they had expected, also up from the 50.3 that we saw last time. So here are some charts showing the mortgage applications index, where it is going up just a little bit when you look at 30-year fixed rates. Here's the refinance index, which also is still ticking up just slightly. The purchase index also is showing a little bit of improvement, and then purchasing and refinancing, we're seeing purchasing leveling off where refinancing continues to expand. Then the ADP employment change did tick up. That was stronger than was expected. And then looking at the monthly nominal, that means you don't take inflation into account. The trade balance, it's still going up. And the nominal exports and imports, we're showing where exports are declining as well as imports. And then the deficit did tick up just a little bit, but we still are negative overall with our deficit. Then the PMI actually turned down just a little bit with the services. And then this is the important one, the ISM Services Index. This is the yellow line that's really coming down. And then that's based on prices. So that's showing that maybe inflation isn't as bad as they thought. And we're seeing a little bit of improvement with the report itself, above 50. And then the job openings are declining overall. That could suggest some economic weakness. But the unemployment claims, looking at the continuing claims, they continue to fall. And the weekly claims, they're below the moving average, even though they did tick up this past week. Here's where we look at all three. I'll update this chart again after Friday when the unemployment rate comes out. The red line are the initial claims that are going up a little bit. Continuing claims are declining, and the black line will be the unemployment rate. Looking at some Isabel Net blog charts, where we are looking a little bit toppy as far as sentiment. We're coming back down just a little bit, and then it has some other things that have been happening along the way. Then we look at the U.S. portfolio strategy, 4,500 at year end and a soft landing. That's if everything works out for the best. 3,400 if we go into a recession. Then the economic surprise index, we're really dropping off a lot right here, where a week or so ago, this was looking more Goldilocks because the reports were coming out not as strong as feared, but not as weak as feared at the same time. But overall, we're showing some weakness when these reports are released, especially in the Eurozone. That's what this chart shows. And then this is looking at the first half of July, where we tend to be more positive. And then the implied U.S. session probability by indicator. I'm not going to read through all of this. Just look at the average. When you take all of these different things together, there's about a 45% chance that we're going to head into a recession based on this chart. GDP. Goldman Sachs is still thinking that we're going to have positive GDP, where the consensus is that we may go slightly negative in the third quarter and we may go negative in the fourth quarter, but then after that they see things improving. Then looking at the budget deficit. This is the biggest deficit that we've had outside of war since 1959. And then the 10-year annualized returns are still low for corporate bonds. They're returning about 3.1%. That's why they're not as attractive. You can get more in a money market right now. And then the sector fund flows is showing a lot of money going into technology and a lot of money coming out of energy. All right, let's get into our charts now. Here's the intraday chart, where this does look kind of scary. Now, on one side, you can say, well, wait a minute. We filled the gap from Friday. From Thursday to Friday, we have that huge gap higher move to the upside. Well, with the decline on Thursday, we filled that. We were able to find some support down here, and then we spent the rest of the day clawing our way back. So yeah, it was a down day, and it was looking pretty ugly to begin with, but it did show some improvement where we closed just about at S1. The intraday chart also shows that the weakness was really picking up before the market opened. That carried over into the cash session. We finally hit a bottom, started to bounce, and we're pretty much flat right now. You have a lot of folks anticipating the employment report coming out. And then large cap growth continues to outperform large cap value. And even though everything was down, growth was down less than value for the large caps, the mid caps, as well as the small caps. And then our growth to value ratio, again, they were both negative, but on a relative basis, growth still was positive on the day. Looking at sentiment, our Ulcer Index is not really moving all that much, suggesting that there's not a lot of fear. But when you look at the VIX, we turned up with the line chart and the bar chart, and the VIX of the VIX is starting to show an increase in volatility. We're keeping an eye on this. We're getting up to the dashed line now. Now, if you go back and look at other times we spiked up and then started to come down, what happened with the market? Sometimes that just produced a short-term pullback. Sometimes it was a longer-term pullback. Other times it actually supported the market going higher. But for the most part, this suggested some kind of a short-term pullback that was fairly intense. We look at the SKU index. We came almost up to this extreme area, and now we're dropping back down. Again, it's pretty much a coin toss here between whether we're going to continue to go up, whether it marks a top or a bottom or a continuation of a downtrend. The equity put call ratio ticked up just slightly with the down day, and the equity put call ratio longer term still remains positive. The AAII report came out for this week. Well, a week ago we were more positive, and individual investors like that, but they're not giving us necessarily an extreme positive reading. We did see fear turn up slightly with this fear gauge, but we still are declining overall. We still are declining with this other fear gauge where we actually declined. The VIX did tick up, and then on top you see the MOVE index. It really spiked up, even though bond prices, they went down very heavily, so interest rates were up, and so we're seeing an increase in volatility in bonds. And we're seeing the correlation coming more back in line with each other. Folks, though, are still favoring a risk-on posture. Our advanced decline line studies, with the down day, we did see a decline based on price and volume, and we saw a little bit of an increase in the new lows, but it was more of not more new highs, but our 5 period is starting to turn over negative, and our 10 period is also starting to roll over. This could actually be somewhat encouraging. On a down day like we saw, to see the new lows not really expand is rather encouraging. The advanced decline ratio did decline, but is still above 0. This is still positive. Look at this, how the accumulation distribution is still advancing above the moving average. This tries to measure institutional buying and selling. But we did see some weakness with our cumulative advanced decline line. We're starting to really break down now and breaking below this previous low. With our regular advanced decline line, we are declining, and now we're in danger of coming back down to this trend line. But this other trend line with the other NYSE advanced decline line that we look at, they're the same thing, but they're calculated slightly different. We're still above this upward sloping trend line. The common stock based on price and volume did show some weakness. And with the down day, the NYSE, the S&P, the mid caps, they all declined, where the small caps declined and fell below the moving average. Our trend does show the green line still on top, but it's declining, but the ADX is dropping below the moving average. And then our short-term chart, we're seeing pretty much that same thing. On a short-term basis, we were starting to get back above 40, which is usually an extreme positive reading. Volume continues to be below average. Then our short-term charts, where we did come back and fill in that gap from last Thursday to Friday, we're still above support based on this chart. And then at the bottom, you see where volume did pick up, but it is still below average. When looking at our double and triple 20-period moving average, we have now dropped below both of those. Looking at our regular 20-period moving average, we're still above that. So if we continue to fall, this may provide some support. With our 20-period exponential moving average, we are declining and we're no longer extreme. We also declined with the 50 and 200. The Williams percent R is no longer extreme. The CCI 14 and the CCI 20 are no longer extreme. The stochastics in the short term, no longer extreme, still extreme but coming down in the intermediate term and still advancing and extreme in the longer term. The force index did decline but is still above zero. Some intermediate term charts, the balance of power did decline but we're still above the dashed line. The composite index, after giving us an extreme positive reading, is now starting to come back down. Looking at our 50-period double and triple moving averages, where we're still above the double exponential moving average, which may be providing some support. The go-no-go system still has the darker blue bar, so that is positive. The TTM squeeze is still looking more negative. We're declining with the darker colored blue bars. We're in the first to second standard deviation on this chart, so we've worn off that extreme positive condition. The PPO studies are still positive, and we tick down in the short term, but we're still above zero. The Erin indicator also falling back after being extreme. The NYSE McClellan oscillator, this is a little more negative. We've dropped below zero. And then the summation index based on price is starting to turn down as well as volume. The other McClellan oscillator that we look at after getting extreme positive is now starting to fall below zero. And this summation index actually showed a little bit of improvement. We're still just barely rolling over based on price and volume with the NYSE summation index. The Swenlin trading oscillator based on price and volume did decline but are still above zero. We're no longer extreme positive with the PMOs that are rising, but we are declining now. The buy signals we're getting just barely extreme positive, but are turning down, and we're flat to slightly increasing with the PMOs that are above zero. The Elder Impulse system for the S&P is switched to neutral. In our PMO study, it's kind of chopping around all over the place. It's still positive, but turning down based on price as well as volume. The slope never did really get back positive, and it's continuing to look more negative. The MACD also is kind of chopping around right now and turning it back more negative. So with the TSI, we're turning back down. The PMO, again, they're really chopping right now. And the PPO, longer term, we continue to be flat with a slight downward bias with the TRIX and the KST. Our parabolic SAR still has the dots underneath, and that is positive. Now, if we see more weakness, a dot could appear on top. Looking at our moving average tree, haven't seen this in a while because we've been far away from these moving averages. We're wondering if these 20-period moving averages will offer support if we continue to fall. The Sean trend meter, which had been extreme positive, is now dropping back down. The BPI actually ticked up a little bit. It ended up closing down, but it saw some strength. So this is showing internally that things are still hanging in there for right now. The NYSE bullish percent index did tick down, but we're still above 50. The Chaikin money flow continues to be positive. And the Chaikin oscillator is also positive. The money flow, it's declining, but still above 50. The vortex is declining with the green line and advancing with the red line, but it's still positive. The ultimate oscillator continues to advance and is positive. The RSI based on 14 periods is coming down. We were extreme positive with the 9 period, and that is now starting to fall. On balance volume did decline, but is still above the moving average. We did see a bit of weakness with our 200-period moving average study for the S&P and also some weakness with the 50-period study. And here's a look at that same chart showing the weakness that has been coming through lately. I have one chart here for our line studies. This is the 20-period simple moving average of the open, high, low, close. We came down to the high, and we found some support at that level, and then we're able to bounce up off of that. Can that continue? Are we going to bounce up from here, or are we going to continue to fall through these moving averages? Our different charts. The Heikin Ashi is looking a little more negative with a black candle. The Kegi chart is still positive, but now pointing down. The Renko chart is still positive, and the 3-line break is still positive. Our different indexes. We saw some weakness in the equal weight index, and it continues to underperform the S&P. Our ratio between the S&P and the equal weight index did tick up slightly. And here's where we're seeing what could be a catalyst for what's happening. We came up to this previous high with the transports, and now we're starting to go back down. Are we going to be able to turn and go back up, or are we going to see continued weakness? We saw a little bit of a turn down with utilities, but we're right about on the downward sloping trend line. The transports to S&P 500 ratio did decline slightly. In a good solid environment, we want to see this ratio going up. And the correlation between the two, it didn't really improve all that much, but it is getting better overall. Looking at our discretionary and staples study, we turned down both with discretionary and staples. So overall, our ratio did decline, but discretionary continues to outperform staples. The transports and the Dow are pretty much even with each other on this chart. The Dow is still right at support at this pivot level, but the diamonds have now switched over to negative for the Elders Impulse system. The NASDAQ is still above this pivot level and actually closed closer to the high for the day, but we still have this 61.8% retracement level above current price. However, inside the NASDAQ, we're still seeing the cumulative new highs, new lows continue to show weakness, and the new highs minus the new lows are below zero. This is also another thing we've been watching. We're below this previous high with the NASDAQ 100, but the bar looks more positive, where we closed near the high for the bar, even though we were down on the day. The QQQs have switched to neutral. The BPI for the NASDAQ 100 did show some more weakness. And the small caps did really fall down through this pivot level, but we're still above the 200-day moving average. Then when we look at the Russell 2000 index, we had a recent golden cross, but our RSI has dropped below 50 and the MACD is turning more negative. The small caps are also turning more negative with the Elders Impulse system, and the small caps are underperforming the S&P. We're still in an uptrend when we compare small cap growth to small cap value, but we are showing a decline. The mid caps are still above the pivot point, but this bar actually doesn't look all that bad, where we put the low in early and then we came back to close well off of the lows after giving a recent golden cross. The mid caps, though, have switched to negative for the Elders Impulse system. Mid cap growth to value is still in an overall uptrend, even though we ticked down slightly. But even though we came down a little bit, the S&P is still suggesting that we might achieve a soft landing when compared to the 3 to 7 year bond ETF. Keeping an eye on the financials, we're still above the 200-day moving average. But the financials continue to underperform the S&P, and the regional bank ETF is underperforming the financial sector. Bonds, this is what really was the catalyst for the market. We really shot up on Wednesday with interest rates, and we just really took off again on Thursday. And when bond yields go up, that means that prices go down. We are showing a real weakness with the RSI, and the MACD is also going lower based on price. But folks are still favoring more riskier bonds instead of conservative bonds. This is also a concern. We're seeing this ratio really going back up, and we might see a golden cross here soon. If the market was more confident about interest rates, we would be seeing this ratio going down, and it's turned and is now starting to go back up. Here's a one-day chart of the rates, just showing how interest rates have really gone up over the last few days. We're still above this 2007 level when we look at the 3-month yield. If we drop down below that, is that giving us some kind of a warning sign? We don't really know yet. We're just watching this. Our long-term charts, we're still positive with the special K on the daily chart and still negative on the weekly chart. And then our rate of change going back 200 periods, we are turning down a little bit. But longer term, this looks like more intermediate term overhead resistance. Our possible positive scenarios: we decline based on price and volume with our 19-day exponential moving average of the advanced decline ratio, but we're still above zero with both. The Qs, well, coming back down to the moving average compared to the S&P, discretionary turned down slightly, and we saw large cap growth outperforming large cap value. With our other growth to value ratios, we're doing okay with the large caps, showing some weakness with the mid caps and the small caps. The S&P to utilities ratio ticked down just slightly, but is still in an uptrend overall. We're still above zero when we look at the Amex, NASDAQ, and NYSE, and then take a 5-period moving average of the highs minus the lows. When we look at the 10-day average of the S&P 500 highs minus the lows, we're still in this extreme positive camp. Now, we're still trying to decide, is the fact that we're staying up here showing good momentum, or are we eventually going to see some weakness and then drop from this level? The 50-period exponential moving average of the new highs minus the new lows continues to show improvement, and our indicator, even though it dropped, is still above zero. But this is a concern. We're seeing the growth to value ratio for the S&P start to show some weakness, although we're still in an uptrend. Looking at the staples, the S&P 500 spike, it did come up a little bit, but we are declining overall. So what's our outlook for Friday? We still have a positive stance, but if we see follow-through weakness, we could be turning more negative. We have the employment situation report coming out, and there's a lot of different reports that come out with that we'll dissect in the video for Monday. We're watching the geopolitical events, especially what's going on in Russia, which now includes Belarus. Inflation and interest rates are really what the market is fixated on now. That's producing growth concerns, which just a few days ago was looking more rosy. Now it's looking a little bit more negative. Here's the updated calendar for the economic reports that are coming out. We still have the employment situation report. And then for July 7th, the Stock Traders Almanac statistics were neutral to positive with the Dow and S&P, and we're more positive with the NASDAQ. We'll be on the 4th trading day of the month, where we still look to be more positive during a pre-election year. And then we're still watching this for the NASDAQ, which tends to perform well into the middle part of July. So our scenarios: hard to go with the down one, even though we saw a pretty significant down day. The technicals, they still could turn more negative if we see more weakness, but they're not negative yet. It's hard to go with the up one right now unless we see a really solid close going into Friday's session. And we can't really go with the sideways trend because ADX, although it's weakening, is dropped below its moving average. So our warning signs: the VIX, even with the down day, is still showing a lot of complacency. It's acting weird, which is why we're having to look at that other chart. The cumulative new highs and new lows for the NASDAQ continue to show weakness. The 3-month yield is still above where it was at in 2007. And then earnings reports that may come out could either be positive or negative. Positive signs: we still have the seasonality and setups behind us that apply pretty much for the whole year. The daily chart for the Special K is positive, where the weekly chart for the Special K is negative. Longer term, we're still positive with the equity put-call ratio. The S&P is still above that downtrend channel upper line. We're still in a risk-on posture, favoring stocks over bonds. The transports are showing some improvement, but have we hit that resistance level, and are we going to start to come down now? Lower price levels so far have been providing support. We need to see if that will continue if we see more weakness. The S&P is still outperforming utilities. The NASDAQ and NASDAQ 100, they still have this overhead resistance at the 61.8% retracement level, but the bar for Thursday looks pretty positive for both. But can they break through that level or the previous high on the NASDAQ 100? The Staples S&P 500 ratio continues to decline. We had a recent golden cross with the Russell 2000 index, but we didn't see that on the small cap index. And the mid caps have also given us a recent golden cross. Small and mid cap growth continues to be positive. So our conclusion: the S&P could be turning negative if we see more weakness. Now, if we see a strong day on Friday, that could switch things more positive, and it could look a little bit better because we've now worked off most of this overbought condition. In the short term, we may be turning negative, but we're no longer overbought. Intermediate term, we also could be turning more negative if we see it's all going to come down to follow through. Long term, we still continue to be positive. Thank you. I'm sorry for my little flub ups in this video. I hope you have a really good day, and I will talk to you in the next video.